Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and hyperbole to give you the information you need for your portfolio. We have Jens Nordvig. He is the CEO of Exante Data and Market Reader. Thank you. And we also have Sydnee Freed, our rock star producer. So on the docket today, we are talking about the U.S. economy. Is it, quote, forever fine? We're going to talk to you about that, Jens. And our word of the day is AI. Is that even a word? We're going to discuss. And this episode is brought to you by the number 2, as in that 2% inflation target that looms large inside those Hollywood Fed corridors. Now, Jens and Sid, the story of the week is the U.S. economy. I want to get to GDP first. That's gross domestic product, a reading on the U.S. economy. By the time you're listening to this at home, we might have the reading, but let me tell you, the expectations are for 2.5% for the first quarter. That's pretty strong. What do you make of this economy?
It's a bit surprising now for many quarters. Really for a year, a lot of people have been saying, okay, the recession is right around the corner, And then last summer, it was kind of like a wake-up call. We cut a GDP number that was essentially 5 in the third quarter, right? There was a quarter when the recession was supposed to be happening, right?
That's amazing.
And we didn't have any setback in the fourth quarter, right? So when you have 5, the odds going to reverse the next one, right?
Yes.
And now we have another one where it's going to be around 2.5, right? So we've had just an incredible string of surprises that really have shocked people's belief in how resilient the economy could be to these much higher interest rates. And what's double shocking is that if you compare to the rest of the world, right, there's been a bunch of other economies where it's kind of going in the opposite direction, at least until very recently, like China has had a massive disappointment.
Yes.
Europe had big issues, right? So the U.S. kind of upside surprises, it's like very U.S. specific. It's not something that's happened globally.
Why do you think this is? We'll get to China specifically in a second, but you mentioned Europe. The dichotomy is huge, and it's often been that way, at least since the time I've been monitoring markets over the last few decades. But why now? Why such the big disparity?
Well, we have the biggest war in Europe since the Second World War going on right now. It's had big implications in terms of like energy supplies from Russia that are not happening anymore, right? So lots of industry in Europe were relying on that cheap energy, and it's not coming anymore, right? So you can see it if you look at production in Germany, it's just tanking compared to the United States. So that's definitely a part of it, and that should not be underestimated. In the U.S., obviously, we still have a situation where we have a lot of funds coming into the economy from the government side, right?
Yes, the stimulus.
It's not
that never dies?
It's not that the checks are coming exactly like in 2020 and 21, right?
I was going to say, where's my check?
Yeah, exactly. So it's a bit different, but it's still there, right? The overall fiscal deficit is very, very high. Like we've never had a situation where there's not a crisis, an acute crisis, and we have a fiscal deficit of 6-7% of GDP, right? So we are injecting a lot of funds into the system through the fiscal account still. Like something you don't see in your mailbox, right, is that we do have the infrastructure. The infrastructure spending is ongoing, right? So that's kind of checks the big company.
If you owned a semiconductor plant, you would be sitting pretty right now.
Oh, yeah, I wish.
I saw a look on your face.
Yeah.
We're talking about GDP.
We're talking about GDP. I want to go back to basics here because this is stocks in translation. I want to go GDP in translation. What even is GDP? What is it? How do we measure it? Why do we measure it?
I'll take the first round here. GDP, the national accounting identities go back to, 1940, something like that. And it was commissioned by, I think Winston Churchill had a hand in it.
Winston Churchill?
This is a long time ago.
Kicking it back.
He was fighting the Nazis. He was about to, and then he was engaged in a long-term struggle, and he had to justify long-term deficit spending, which at the time was thought to be a no-no, that you're never going to get away with this. Now, that's a somewhat, there are various interpretations of exactly how this went down, but the net effect is that we came out with these apples to oranges numbers, like you can put a GDP number on the entire economy of the U.S., one number. So you got to take these things with a grain of salt, but you also have to measure things in the first place. And so once we got these national accounting identities, and there are different components of them, inflation is one, we can measure that different ways. I think it was all to be able to however you want to look at it, whatever the concerns were at the time, they wanted to be able to do different things with their economy. And that was kind of the justification. Yes. Jens.
Tap it in.
So this
Tell
is
me.
like going back to first year in economics in university. So I studied economics for 100 years. So it's nice to go back to the first
100
one.
years?
I should have let
almost.
you start this question. Please prove me wrong.
But what we're trying to do is we're trying to measure, okay, how big is the economy? How is the economy growing, right? And this is a pretty complicated thing, right? Because the economy is big, there's all kinds of sectors, right? There's three ways of doing it. So the one we're used to is we say, okay, how are people spending money? So how are people consuming at the household level? Like, what are they investing at the business level and government spending? So that's the expenditure thing. Another way of doing it is, okay, what kind of income are people getting? That's another way of measuring it. And a third way of measuring it is like what is actually being produced, where you run around kind of industrial production, energy production, and so forth, right? All those things in theory should add up, but they don't. But so we have three sets of measures of the size of the economy and growth.
I'm so glad we invited
I
an
learned
economist
something
today.
new. Yeah, there we
All
go.
right. Jens, we mentioned China a minute ago. I want to get to that now because you worked for Goldman Sachs back in the day in emerging markets. Tell us about what's going on with China. The restart of their economy didn't live up to the hype, but where are we right now?
Yeah. Like when we had all the different COVID waves, right, and different countries opening up at a different timetable, like China was by far the last, right? They shut down the economy for a long time, and they finally opened. And when they opened, it was tempting to think, oh, okay, when they open, it's going to be similar to all the other economies that's going to reopen, right? We're going to have inflationary pressures, there's going to be a demand boom and so forth. It didn't play out like that at all. And the one reason is that President Xi has a totally different way of thinking about stimulus. So stimulus in China is about building productive capacity.
They call it social financing, I think.
Yeah, but there's not really a tradition of giving people money to spend. So that was not done in China. The stimulus is typically like, okay, here's a government enterprise or something that needs to invest more, or a bridge being built, or an airport or something like that. That's how stimulus was done. And there was the same thing in this cycle. There was very little checks sent around to Chinese citizens, right? So when they escaped their lockdown, there was not the same consumption boom at all. And at the same time, they had a housing market that is in a full-blown meltdown, right? So they've had a couple of decades, I think it's fair to say, of overbuilding, right? And they don't have population growth in China anymore. So like an
important point.
Yeah.
Demographically, their boom has kind of plateaued.
And you can even see it in, if you look at fertility rates, right? It used to be the case that, okay, they were certainly below 2, and now that fertility rate has also dropped. There's something about the COVID shock that has changed the psychology in China to a degree where people literally don't want to expand the family anymore, right? So lots of things going on. And one thing that's really important from a global perspective is that since China didn't play out like all these other economies and didn't generate inflationary pressure, we actually have the opposite coming out of China. We have all this excess production. We talk about a lot in terms of electric vehicles. We don't import a lot of them in the U.S., but globally, electric vehicles from China is massively important, right? And they weren't there 5 years ago. It's a totally new thing. They're putting downward pressure on prices. So we actually have this, even though we talk about inflation all the time, if we look at what the impulse is from China, it's actually a deflationary one. And we can see that when we dissect the inflation numbers in the U.S., you can see that there's two things going on. There's services are expensive, and now the goods price is actually starting to be really under control. No inflation at all, and China's an important part of that.
Excellent. Now we have to move on to the word of the day, which is AI. So maybe it's a phrase, but yeah, you're the CEO of a couple different companies. One is Market Reader, and you're trying to give reasons why the market is moving. It's as simple as that. But it's a large undertaking, and the tools to be able to do this have only emerged very recently. Tell us about how you go about this.
Yeah. It's a simple problem, but it's not so easy to solve. So the issue is that if you're trying to explain what's going on in the market using, just one angle, it's going to work once in a while. But in order to really explain all the different moves in the market, you need to have a very kind of multi-dimensional approach. So when you set up a piece of software, an algorithm, AI assistant, and so forth, it's important to be multifaceted and have like really cover different dimensions, right? So just name a few of them, right? So we can certainly have a news dimension. We can have a social media dimension. But we also need to know in the system how different assets are related, right? When United Airlines move, it's very often that Delta Airlines move. Like, so the system knows that.
Software, and I really like that it gives you the sector correlations historically and just tell you exactly. Sometimes there's actually no news. Sometimes it's just a stock is moving because its industry group is.
A lot of what we're trying to do is to weed out the noise.
Thank you.
Like if like there's so much noise in, like if I pull up like a JP Morgan news feed, there's going to be 35 stories every day, right? And most of them are totally irrelevant, right?
That's the worst part.
So so our system is really designed to get rid of the noise and say, okay, this is the important bit, so that investors can very quickly get the gist of what's going on.
Why is it that like sometimes the markets are moving in a way that you think they're reacting to some data point and you agree, and sometimes it's moving in like the opposite direction, or it's
like
not
good
moving.
News is
or
bad news?
Good news is bad news, or just like,
or why is it good news?
Or why is it good news, or why is it not moving? Why is it flat when you think it should be moving?
Yeah.
You know, what accounts for all that?
So I think when we're building a tool like this, it is also important that we have a degree of humility in the system. Like, so we can certainly have instances, right, where there's a company that reports earnings, and the earnings are very good, the revenue looks very good, guidance is very good, and then the stock is down. Or like yesterday, when Tesla came on with the opposite, the earnings were not very good, revenue was not very good, and the stock was up 10%, right? So in those situations, I think it's important that the way we design the algorithm says, and actually we have this overnight, we have, okay, the earnings release on the normal metrics didn't look very good. Despite of that, Tesla's stock is up a lot. This is literally what the system wrote. I'm very happy with what the algorithm did.
I would take that, because there's nothing worse than some kind of false hubris where somebody, and I see this in the media, the financial media all the time, where they say, all right, this stock is up and it's because of X, or they imply it. And a lot of times it's just not true.
So we want to have a humility in the system where we do the best we can, right? And if it's a complex situation, it could also be social media says this and the newswire says this, and it's not consistent with each other. Then we want to convey that there's this sort of mixed opinions. Yeah,
and also you have to consider the macro backdrop. If the market is in a bear market and the Dow is down 1,000 points that day, your earnings result might not matter.
Right.
Absolutely.
It doesn't make the cut.
Yeah.
All right, for our viewers on streaming platforms, we're going to take a quick break. And for everybody else, well, guess what? We're going to continue. All right, this episode is brought to you by the number 2, and that's the official inflation target of the Federal Reserve. So let's talk about inflation here. We talked about GDP before, and part of inflation is Consumer Price Index. Now, we got 2 main measures. CPI, as it's called, came in a few weeks ago, earlier in April, for the month of March. Headline number annualized to 3.5%. This means prices were on average 3.5% more than March of 2023. Now, we get a separate measure of inflation at the end of this week. The Fed likes it a little bit better. It's called Personal Consumption Expenditures, or PCE. That number is expected to be 2.6%. So different amounts, 3.5 versus 2.6 expected. Bottom line, both of these numbers are above 2%, which is the Fed's goal. What do you see going on with inflation right now?
So right now, the big picture is that we had incredibly high inflation 2 years ago, right? Touching 6-7%, depending on how you want to measure it, right? And now we've had a significant improvement, but we're not quite at target yet. That's why the communication from the Fed is kind of confusing now, because on the one hand, they're happy with the trend that we're on, but they're not at the end destination where they want to be yet. So like, how do they talk about that? It's complicated. There are some technical issues going on with CPI, right? So if you go back to January, just giving you a kind of a crazy example, like one of the things that moved a lot in January was the price of nursing homes. Okay, does the price of nursing homes adjust every month? No.
I would think not.
This is something you get an invoice once in a while, like you pay for your parents or whatever it is that's happening, right? But it's in this category of things where you can call it reset effects. Like there's a reset effect happening once in a while. It's often that the reset happens early in the year. You're going into a new budget period for the companies that operate those businesses. They have to reset, right? So when we look at what's happened in the last couple of months, where a lot of people have been disappointed that inflation is not coming faster down to target, it's really important to think about, okay, what is it that's going on? Is it, okay, inflation is going back up again? Or is it a couple of months where we have these reset effects? And I think there's a fair amount of evidence that there's these reset effects that are important in January and February, maybe in March as well. We can see that in Europe as well. They had some of it in January and February, and now we've had March data that looked a lot better. So I think when we look into the second quarter in the US, things will look better on inflation. The caveat is that it's not only on inflation that the Fed's job has gotten hard. It's also because the labor market actually looks quite strong, right? So
yes,
there's something going on the growth front as well. So I think overall, right, the message we've gotten from the Fed is that they're not in any rush to cut, and that's understandable because both looking at the growth side and on the inflation side, like, it's not totally clear cut that they need to pun intended, I guess, to cut right now. Yeah.
We're talking, there's two measures, right? There's CPI and there's PCE. We call PCE the Fed's preferred inflation gauge. Why are there these two different measures? And at base value, I understand they contain different things. But if PCE is preferred, why don't we just use that? Why don't we get rid of CPI?
Yeah. I think the CPI is the measure that's been around the longest, right? So it's like, people have
tradition,
something they attach to, and it's also something that's available around the world. IMF and other global institutions use it. So it's hard to throw the CPI out. But the Fed likes the PCE because they are meant to serve the people, right? And this is personal consumption, so it's the inflation that the consumer is seeing. So it sort of makes sense from that perspective. And then there's some more technical things, like it's weighted in certain ways that they think make more sense. And the reason why the two things are different has a lot to do with how rent is weighted.
Yes.
Like the rent is different.
And there's all kinds of assumptions made. These are humans making assumptions, a lot of assumptions about a very big space that we call the United States of America, which itself is pretty big, I hear. All right, we've covered inflation, and I want to talk about gold now. This is something that we haven't really talked directly about, but putatively, it's an inflation hedge, and there's no denying that the price of gold is on a tear. It's exploded to 2,400, almost 2,500, stuck in a trading range for a while. What's your view on gold?
So we live in a very complicated world. We discussed a few minutes ago that we have the biggest war in Europe going on since the Second World War, right? So this is a situation we've not had for many, many decades. This weekend, it was announced that the United States is going to confiscate any Russian deposits that are in U.S. banks. So this is again related to the Russian invasion of Ukraine, that this is kind of like a punishment for that. The money, which is around $6 billion, is going to be actually literally given to fund the support for Ukraine. So why am I mentioning that in relation to gold? It's because these sovereign links that we had, Russia, US, China, US, and so forth, it's all a part of having like a credible global financial system. But if we start to seize each other's assets...
Change the rules of the game.
Yeah, and you can actually see it. The reason Russia only had $6 billion in deposits in the United States when they invaded Ukraine was that they had already sold all their U.S. treasuries in the years before. So they were already getting concerned. So if you're thinking about these countries that needs to manage their assets, their reserves... Like, what kind of assets are they going to be comfortable? There's an argument that they would be more comfortable holding assets such as gold as opposed to sticking them into deposits in the United States where there's like, a hostile relationship. So I think that's an important part.
I think, that really makes probably one of the better arguments for the secular case for gold this decade. If you think geopolitics, if you think we are on the way towards a smaller, more bifurcated world where we have Russia and maybe China, and not even bifurcated, trifurcated. If you consider that, what are these entities holding? Gold. We saw Russia de-dollarize before the first invasion of Ukraine. I mean, Russia's been buying gold going back 10 years that I've seen in anticipation. You mentioned that $6 billion in gold. Do you happen to know what fraction that is of their total gold? Like, how much are they actually holding versus what they're going to have to give up, if you happen to know that?
Yeah, so the $6 billion is the amount of money Russia literally had parked in U.S. commercial bank accounts like JP Morgan and so forth, right? In terms of what they have in gold, I don't think they're disclosing it fully anymore.
I wouldn't be surprised.
The World Gold Council actually has some data where they try to collect from speaking to gold dealers around the world how much gold has been bought by central banks. And the data that they publish show much more gold accumulation than the individual central banks actually report. So within Exante Data, we literally have like a metric we call like the undisclosed amount, which is the difference between those two things. And it's growing a lot. And it's really taken off after Russia invaded Ukraine. So the theory I conveyed before is kind of backed by the data. There's something new going on here. The other thing that's going on, which is more recent, is that there's a lot of retail demand for gold in China. And the reason for that is that in China, everything is controlled. You cannot take money out of the country very easily at all.
They outlawed Bitcoin.
Yeah, it's a very good example. But gold is not outlawed. So gold is one of the kind of outlets of having, an asset that is not a Chinese asset. It's kind of like even if you're holding it in your pocket, right? It is kind of like a globally recognized asset. So there's something going on with that Chinese retail demand, and it feels to me like it's the one type of capital flight out of Chinese assets that's kind of allowed. And it makes a lot of sense that Chinese residents then will focus on that one area where it's not something criminal they're doing, and they're doing it more and more.
All right, we got time for one more segment there, and thank you for that explanation on gold. Learned a lot. Guess what? I'm hearing something. Is that a knock? I don't know. It's Hollywood knocking because it's time to roll out the red carpet here for a round of Who Wore It Better. And this is Fed Speak edition. So we're going to get some commentary from Fed officials. We know that inflation has come down quite a bit from the 2021 highs, but that drop has stalled out by many metrics, which we've been talking about. We know that Fed members, that's the Federal Reserve members, penciled in 3 rate cuts this year, a few months ago, but the inflation data may have changed their view. 3 rate cuts, and now it's a little bit different. Here are what 2 current Fed members have remarked on this ominous development. Here's Neil Kashkari. He's a president of the Minneapolis Fed. He said, I'm in the view of we need to wait and see, be patient as long as it takes until we get convinced that inflation is on its way to 2%. And then Austin Goolsbee, he's a Chicago Fed president, said, right now, it makes sense to wait and get more clarity before moving. My question to you, Jens, which Fed member takes the win on getting the message out that the Fed needs more evidence to make that critical first cut?
I think Goolsbee said it in a very succinct way, just a few words, like there's no rush here. They can wait.
Right now, it makes sense to wait.
I'll go with him. Yeah.
All right. I'm a Goolsbee fan, too. I like succinct.
I'm a Goolsbee fan because I say his name Goolsbee.
I'm always worried that I'm going to pronounce it wrong. To be honest.
All right. Looks like we're winding down here on Stocks in Translation. We'd be remiss without telling you what's on our radar in the coming days. So we got this GDP, we got PCE, but we're also tracking earnings. Guess what? Next week, we got Amazon, AMD, Pfizer, drumroll, Apple. See if they can come out of the Apple doldrums. Anyway, thank you for watching Stocks in Translation. Sid, Jens, thank you for stopping by.
Thank you.
Thank you.